Good morning. My name is Virgil Dismeyer, and I will be your SCORE host today. Today we are going to discuss a topic that is germane to every business. That is, how are you going to legally organize your business in your particular state of operation? There are liability, tax, and operating implications for each type of corporate entity. We are very fortunate to have a local expert, Peter Brehm, to help sort out your options. He will now take over and introduce himself.
Good morning. Well, I shouldn't say good morning, should I? My name is Peter Brehm, an attorney in Minneapolis. I am licensed in the state of Minnesota and in Arizona, and I work almost exclusively with small business owners, helping them set up businesses and operate their businesses and wind down their businesses. Be much of a lawyer if I didn't have a disclaimer at the start of this presentation, and so I provide one for you here. If there are people in other states that are listening to this, obviously the laws of states are different. Each state or each situation is fact-specific and fact-dependent. And if you have any questions about what we're talking about here today, you should talk to your counsel, because what I'm going to try and do is give you a general overview of tax implications and operational implications and legal implications for setting up a business and choosing a business structure. So if you have a question that comes up, you should talk to your attorney or your CPA. What we are going to talk about today is some of the general issues related to all business structures, including sole proprietorships and partnerships. We're going to talk about the different types of structures you can get into. We're going to talk about all structures that are here. There are some more obscure structures that I'm going to sort of skip past today, but there are some other entities out there like limited partnerships and limited liability partnerships that you might want to look into. We're going to talk briefly about how to set up each structure in the state of Minnesota, and then some other issues and some resources that you can look at when you're setting up your business. When people come in and ask me about talking about setting up a business structure for their business, I talk to them about three basic issues that relate to these to their structure. And there are legal issues, which obviously deal with things that are right in my wheelhouse. There are tax issues also that govern which entity might be best. And then there are also business and operational issues like fundraising and minority shareholder issues that come up. And so when we talk about each of these entities, we're going to talk about them in terms of favorability and maybe some not favorable characteristics related to both legal issues and tax issues, but then also business and operational issues as well. Because I'm a lawyer, I like to start with the legal issues, and I think primarily the legal issue that most people want to talk about is liability protection for the operations of the business. If you are operating a business and you are dealing with vendors or using contractors or any of those things, there might be owner liability, there might be director liability, and officer liability that would arise from the operation of the business. Another issue that comes up is who can act on behalf of the business, officers or partners or agents of the company. People are also concerned oftentimes about having to take extra steps to set up the business or operate the business. And one thing that comes up that people tend to overlook is that most of the time when you are dealing with companies and you're issuing either debt, doing loans with something other than a bank, or you are selling securities like stock or membership units, securities law applies in both state levels and federal levels. So these are some of the legal issues that will come up, and we'll talk about some of them with respect to each entity. Aside from legal issues, there are clearly tax issues, and when people get into business, they obviously are concerned about things like deductions. Can they reduce their tax footprint? Can they maximize the amount of cash that's available to the business and improve their cash flow? But they also ask things like, do I need to file a separate tax return? whether the business pays income tax on its earnings, and one of the most significant ones for small business owners is whether you have to pay self-employment tax. And self-employment tax I'm going to refer to a lot in this presentation. For those of you that don't know, self-employment tax is the Social Security and Medicare piece of wages that you earn, and that number is 15.3% of the first $118,500 of the income that a self-employed person earns, and then everything over that amount is 2.9%. So that can be a significant expense for the business and for the business owner. And finally, we talk about operational issues. These are things about how the business itself is structured, how the entity functions, and some of the questions that come up are how much does it cost to set the business up, whether or not there are limitations on the type of owners the business can have, whether the businesses can be owned by trusts or other businesses or individuals or foreign citizens. Questions about how long the business will last. Does it survive the death of a business owner? Selling the business obviously is a big concern for a lot of folks. You're building a lot of wealth. Most small business owners have a significant portion of the value of their estate tied up into a small business, and they would like ease to sell the business. And obviously most important is that if you've got a business plan and you have a desire to bring do a round of financing coming up, is the structure flexible enough to fit your goals to bring in investors or fit your goals to hire employees or to grow? So we want to select a structure that will be flexible enough to accommodate your personal goals for your business over the next 3 or 5 or 10 years. Now we're going to get into the types of business structures that there are available to you, and some of them are organized structures and some of them are unorganized structures. Unorganized structures are sole proprietorships, people who are in business for themselves, and partnerships. You'll note that I put a statutory reference to the partnership. That statute does apply to those relationships that you set up. So it's not organized in the sense that we don't file anything with the Secretary of State's office. It's just, but it is governed by a state statute. And then when I talk about organized structures, I'm talking about things like limited liability companies, which are governed by Minnesota Statute 322C, S corporations under 302A, and C corporations under 302A. And the reason I give you these statutory references is not that you need to go and memorize these things, but if you select a structure, it really serves your purpose to at least familiarize yourself with the limitations that the statutes have for the operations of the type of entity that you set up. And the other reason I provide is that you'll note that S corporations and C corporations have the same governing statute. That's because for state law purposes, S corporations are the same as C corporations. Even though people talk about them differently, the designation of S or C for a corporation is strictly a tax difference, not a organizational difference. The first kind of unorganized structure we're going to talk about is where people will usually default when they start in business for themselves, which is a sole proprietorship. If you are in business for yourself, using your personal name, you are deemed to be a sole proprietorship under state law and for tax purposes as well. One of the upsides of being a sole proprietor is that you don't have to file anything with anyone to do business in your name, but you'll note that we put an asterisk next to that. And that asterisk represents the idea that if you're going to operate your business in a name other than your own personal name, you need to file with the Minnesota Secretary of State's office for an assumed name. But that's the only filing that's required to set up a sole proprietorship. There's no separate tax return per se, but you will file the Schedule C on your 1040, which is in itself sort of a separate tax return, but at least you don't have to do 2 separate filings. The drawbacks in a sole proprietorship is that if you're in business for yourself, the law says that you and your business are the same person. So the liabilities of your business operations, whether it's personal injury because one of your employees ran somebody over, or whether it's a vendor contract that went bad, those liabilities of your business are your personal liabilities, which creates a lot of risk that otherwise we could avoid. And we'll talk a little about that later when we talk about the organized structures. Also, because you're a sole proprietor, you're going to pay self-employment tax on every dollar that you make. That's that 15.3% tax rate. It's really difficult to sell a sole proprietorship. What you can sell is the assets of the business. But when people go in to buy a business, it's much more difficult to sell a business that is not organized and hasn't been run in a way that the business is different than the owner itself. Also, it can be difficult to deal with third parties like banks and customers and vendors because there's a perception out there, whether it's legitimate or not, that if you're a sole proprietorship that you're not doing your diligence and you're not really professional and not dotting your I's and crossing your T's. So there's some people that you're going to deal with as professionals that will not want to work with you if you're a sole proprietor. And the last one is limited life, which means that when you die, your business goes away. If you become disabled, your business just goes away. There is no continuity for that business or no plan for that business to be able to continue on after you have passed on, which is not the goal for a lot of small business owners who want to pass on, if not the business itself, the value of the business upon their death, and that's much harder to do if you're a sole proprietor. Like a sole proprietorship, a partnership does not require any filing with the Secretary of State's office. If there are two or more people who are working together for a common business goal, you are deemed to be a partnership. So there's no filing required to set that partnership up. Again, I put the asterisk in there to remind myself that this partnership is going to do business in a name other than the names of the partners, it needs to file an assumed name with the Secretary of State's office. Another benefit of the partnership is that a partnership does not pay tax on its income. So if there are three owners of a business and that business makes $100,000, the partnership doesn't pay tax on $100,000. It just reports on the tax return that it was owned by these three partners, and each of those partners pay tax on their share of that income. There are some fairly serious drawbacks for partnerships, the least of which is that there's a separate tax return. It's a Form 1065. Again, that 1065 is just to tell the IRS how much money the partnership made. The company does not pay tax itself as a general rule. The larger drawbacks, though, are, like a sole proprietorship, there's no liability protection for the owners of the company. So if your partnership ends up having a $300,000 debt with a vendor, and that vendor sues, they can sue you as a partner, and your personal assets are subject to collection efforts by that creditor. And what makes it worse than a partnership in a lot of ways is that each partner is equally able to bind the company whether the other partners know about it or not. So that if one of your partners went out and entered into a contract you didn't know anything about, and the partnership ended up owing several $100,000, the creditor could sue you personally without even suing the other partners for a debt that you didn't even know about. And the other problem with the partnership is that if one of the partners dies, the partnership winds down and dissolves because just as a matter of state law. So we don't have perpetual life beyond the partnership. To solve some of these limitations for sole proprietors and partnerships, a long time ago corporations were invented. And invented is the wrong word, but they were created. And corporations are considered to be people which are independent of the owners of the company. So one of the main benefits of setting up a corporation, a C corporation, is that the owners of the business, the officers and the directors, except in very limited circumstances, are protected from the liabilities of the business itself. So that if a C corporation is sued by a customer and that customer gets a judgment against a C corporation, that creditor, that customer, is limited to collecting those monies from the corporation itself, not from the owners. Another benefit of a corporation is centralized management, which is to say we have officers and directors, and those parties have discrete responsibilities and authority to act on behalf of the corporation. So when we talked about that partnership example where one of the partners ran off and started setting up or entering into contracts, we wouldn't have that with a corporation because only certain officers will have certain authority to bind the corporation. Another benefit of the corporation is that anyone can own it. There's no limit on the number of owners or who can own. So trusts can own a C corporation, and other corporations can own that. Foreign citizens can own a C corporation. So there's no limitation on the number or on the type of people that can own a C corporation, which makes it valuable if you are using or raising money through investors. Anybody and anything can invest in a C corporation. Plus, you have great flexibility in creating the different kinds of equity in a corporation. If you've heard about preferred stock, C corporations can have preferred stock. Preferred stock gives a separate payout for, or a preferred payout for certain kinds of stock, and we can structure those any way we want. So if we bring in an investor who wants to get paid the first $1 million of profit for the company, we can do that, have a separate type of class of stock. We can also create non-voting stock. So if we bring in investors, they can get income from the business, but we can keep control of the corporation. One of the real benefits of the C corporation was continuity of life, which is that if one of the owners dies or if the owner dies, the corporation still exists. So that business can continue on beyond the life of the owners of the company. And if you retain the profits in a C corporation, there's no self-employment tax. So if a company made $100,000, we wouldn't pay self-employment tax on that $100,000, which at 15.3% would be $15,000 better for the corporation. But there are some significant drawbacks for a C corporation, which is to say that because the law and because the IRS views the C corporation as a separate entity from the owners of the company, the corporation itself pays tax. So unlike that partnership example where we talked about $100,000 coming into the company and the company paid no tax on it, if $100,000 was made by the C corporation would pay its tax rate, and then when the money was distributed to the owners would pay taxes on the remaining money. This is called double taxation, which creates a real problem for a lot of companies, especially small businesses that need to keep more cash in their operations so they can keep paying bills and hire employees and buy inventory and those kinds of things. Another drawback in some people's minds is that there's a separate tax return for a C corporation, and there are some higher administrative costs that go with keeping a separate entity that you would not have with a sole proprietorship. So the limitations and drawbacks of the C corporation were double taxation, and that issue was a big one for small businesses we talked about. So the IRS and Congress at some point created what they called a small corporation, an S corporation. And they said if it's a small business, we shouldn't have that double taxation issue. So we set up an S corporation the same way as a C corporation. The law says it's a different person than the owners of the company. So we have the same liability protection that a C corporation has. We have centralized management just like a C corporation has. But in this case, the corporation doesn't pay tax on the money that is earned by the corporation. An S corporation is what we call a pass-through or flow-through entity. Like a partnership, the tax return that's filed by the S corporation, which is an 1120-S, serves really just to tell the IRS what the income and expenses were for the year. And then if there's a profit at the end, it tells the IRS how much of that profit is earned by each of the owners of the LLC or the S corporation. So we avoid the double taxation, and we get some flexibility or get the same liability protection. We get continuity of life. And we also avoid the self-employment tax on money that is retained by the corporation and not paid on salary. And we can use the cash method of accounting for our purposes, which for small business purposes is oftentimes a large issue. There are some real drawbacks for an S corporation. One of the smaller ones, again, is a separate tax return. But that tax return is really just to allocate the income or losses to the owners of the business. There are the additional administrative costs with having a separate corporation. But the bigger ones are that there is a limit on the number of owners for the corporation. It has to be a small corporation, which means it has to have 100 shareholders or fewer. In my experience, it's not really a huge issue because most businesses aren't owned by more than 5 or 6 owners. So I rarely see something get up to 100, but that is a limitation. The larger limitation is that the owners of the corporation have to be natural persons, except in very rare circumstances where a trust owns all of an S corporation or another S corporation owns all the stock of an S corporation. LLCs, corporations, and trusts cannot own S corporation stock. And there can only be one class of stock. So if you own 50% of the stock of an S corporation, you get 50% of the profit, 50% of the losses, and 50% of the voting rights for an S corporation. We can't create preferred stock and have preferred payouts for S corporations. So on those last 2 points, you can see that if you were going to raise money through angel investors or angel investors or any sort of third party, typically those people are going to want to invest through their LLCs, and those LLCs cannot invest in an S corporation because they can't own stock. And those kind of investors usually want some kind of preferred stock or preferred payout, and you may not want them to have full voting rights. And so if we have an S corporation, those limitations will sort of limit what we can do in terms of offering securities to raise money. So in about 1978, I think it was, the great state of Wyoming decided we're going to try and figure out something that will take the best parts of a partnership with the best parts of the corporation and blend those together into a new entity. And they created these limited liability companies. The benefits of a limited liability company is, as the name suggests, the liability protection exists for owners and officers and directors or governors of the company. There was some concern earlier on, probably about 10 years ago, that the liability protection for LLCs might not be as robust as for corporations, but that has been resolved by both case law and by statute, so that the liability protection for corporations and the liability protection for LLCs is pretty much identical. We can also have centralized management with an LLC. So we limit the ability of the owners to go out and bind the corporation like we had in the partnership. And another benefit is that the company doesn't pay income tax. Like an S corporation, it is a flow-through entity. That is that it files a tax return just to show the IRS how much money the partnership made or the LLC made and how much of that money is allocated to each of the owners of the company. We have now perpetual life available for LLCs, though we can elect to have a specific date that the LLC will last. But that continuity of life allows the LLC to survive beyond the removal or death or retirement of one of the partners. I have down here is no separate tax return if you are a single member LLC. The IRS says that you are taxed as a sole proprietor. The IRS says you're a disregarded entity. They don't think you exist. So you will again file a Schedule C on your 1040 if you're a single member LLC, and you don't have to then file a separate form 1065. If you are a two-person LLC, then you would file that Form 1065. If you are a married couple and you are the two owners of a company, you can elect to be taxed as one owner, or you can elect to be taxed as two. It's the choice that you can make when you set the business up. Actually, I have that slide coming up next too anyway, so we'll talk about that in a bit. Drawbacks of single-member LLC is that you pay self-employment tax on all the money you make. Some jurisdictions, I believe, still do not recognize single-member LLCs as entities, and if you add a member to your partnership or to your single-member LLC, you've changed from a sole proprietor into a multi-member LLC, which might have some tax consequences. So 2 or more people set up an LLC, as we talked about. That is taxed as a partnership. We still have the same liability protection. It can be owned by anyone or anything. It can create preferred equity so that if you are going to raise money for your company and an investor wants to come in and get preferred payouts or to have restricted voting rights, we can do that with a multi-member LLC. Again, the company does not pay separate income tax, and there's continuity of life. And as I talked about before, there's wait a minute. I got that slide down wrong, and I apologize for that. There is a separate tax return. It's 1065. It's not a disregarded entity if it's a multi-member LLC. It is a tax as a partnership. And another drawback is you pay self-employment tax on all the earnings because the IRS says you cannot be an employee of a partnership in which you are a partner. So in an LLC, as opposed to an S corporation, that 15.3% is going to apply to the first $118,000 that I make as a partner, and then 2.9% after that. So when people come in and talk to me and they ask about which entity they should set up, obviously, if you can get a business plan put together, and SCORE does an excellent job of helping people put together business plans, that helps your lawyer really figure out, well, which one is going to be the best for you. As a general proposition, and this is not, I hate to give straight legal advice like this, but sole proprietorships and general partnerships should be avoided because they create this additional liability for the owners. I don't see a purpose or a reason to do either one if you could possibly avoid it, because the risks that are associated with it far outweigh any of the additional expense of filing, and I think the filing is $155, so that's a fairly cheap insurance policy. Assuming you comply with all the statutory requirements, both corporations and LLCs provide the same liability protection, centralized management, and continuity of life. So there's no real distinction between the three entities for those purposes. The benefits of C and S corporations is that they provide you with relief from that self-employment tax, that additional 15.3% that you pay above the ordinary income tax rate. S corporations provide, and LLCs provide relief from double taxation. If you set up a C corporation, we have that double tax issue, and all the flexibility kind of makes it more difficult because now we have to pay twice the tax that we would otherwise. And C corporations and LLCs both provide flexibility in who can own equity and the types of equity that can be offered. So if your business plan involves bringing partners in or doing angel investing round or something like that, and you know that you're going to need to get financing other than bank financing, or you're going to bring in partners, then maybe an LLC or C corporation would be best. If, on the other hand, you know that you're not going to need a partner and you're not going to do financing, and you really just want to maximize the tax benefits of avoiding self-employment tax and double taxation, an S corporation might be the best venue. And these next two slides give you really a summary of the characteristics for each of these entities that we talked about. And if you go through this checklist and you can kind of process these, I think that should help you kind of figure out exactly what the upside and downside is for you and your business plan for each of the entities that we have. So if we get to the second slide, we see that a sole proprietorship, nothing applies. General partnership can be owned by anyone or anything. C corporation can be owned by anyone or anything. S corporations have real limitations on who can own, but everybody else, all the other entities can be owned by other businesses and that kind of thing. So greater flexibility in those. Once you've decided that you're going to pick one entity or the other, setting up a business entity is not that difficult to do, and frankly, it's fairly quick now that can be done. To establish your business, if you go to that Minnesota Secretary of State's website that I gave you that link for there, you can complete the Articles of Organization for an LLC or the Articles of Incorporation for a corporation. And you can file it. You can pay the filing fee online. I think it's $155 total. And they walk you right through it, and you will create as good a business as any lawyer can create and have the same liability protection. The next step after you filed your articles with the Secretary of State is to create your bylaws or operating agreement. This is the agreement that exists between the owners and the corporation about how voting will get done and how income will be allocated. And there are some forms for those things available too. Once you've created those documents, you will purchase your shares or units with a contribution agreement. You'll elect a board, governors for an LLC, and directors for a corporation. You can appoint yourself an officer. If you're going to do business in a different jurisdiction, so if you're going to have salespeople going into Wisconsin or Iowa per se, you may need to file with each state as a foreign, register as a foreign entity, just to let their taxing authority know that you are there. Every place that you do business where you have a physical presence, what we call nexus, would give that state the ability to tax you. So if you think about in terms of Amazon in the state of Minnesota, for years there was no sales tax on things that Minnesotans bought on Amazon, but as soon as Amazon built a building in Shakopee, now everything is subject to tax. It's the same thing. If you're going to establish a physical presence in a state, you may need to register as a foreign entity in those states. If we are doing an assumed name, and not just sole proprietorship or partnership, but corporations and LLCs can have assumed names too, you will file that assumed name with the Secretary of State's office, and then you have to publish it in a legal newspaper for, I believe, 2 months, something like that. And then once you've published it, then you can start using it. One of the most important things to do once you set up is to notify the taxing authorities that you are doing business, because they're really interested in your business. They're very interested in your business. So it used to take weeks to get an employer identification number. That's what the EIN means. You're going to go to the IRS website, and the form is the SS4, and you can now file it online, and you can get a taxpayer ID number, your EIN, right away, which is very helpful. You'll need that to set up a bank account along with your Articles of Incorporation and Articles of Organization. If you decided to set up an S corporation, you will need to file the S election with the IRS as well. It's a one-page form, potentially a two-page form if you have some extra detail, and that just tells the IRS who the owners of the S corporation are and that they've all agreed to make that S election. That S election has to be filed within 75 days, I believe it's 75 days, of the date that you incorporate, so that that election will be guaranteed. If you go after 75 days, you have to file a separate form with the IRS to get them to tax you as an S corporation. You also have to apply for sales tax, workers' comp, unemployment numbers with the Minnesota Department of Revenue as well. So when you go to the Minnesota Department of Revenue website, they will walk you through it and help you identify which piece of information you need there, and I gave you that website as well. On these other issues, I think it's important for us to talk about how to protect that liability. We've spent a lot of time talking about liability protection for owners. That liability protection exists only to the extent that you treat the business as different than yourself, which means that you can't commingle your funds and treat the business assets like they're your assets. the business has to be treated as a different person than you. So among the things you have to do is have owners' meetings at least annually to sit down and say, this is what we did in this last year, this is what we're going to do for this next year, and we agree to that. You will need to have separate bank accounts, separate credit cards, and you're really going to want to keep track of all the money coming into the business and the money that's going out of the business. So if you're going to loan money to your corporation or your LLC, document that. Just write down on a piece of paper, I loaned $50,000 to my LLC. On this date, it will accrue interest at 4%, and I'll pay it back when I can. Keep those in pieces of paper in the file to document that the business, the money that's coming in from the business, has a business purpose to it. You're going to want to have insurance to protect your liability, obviously. And when you talk to an insurance agent, it's just important to talk through what your plan is, what your sales are, and then you're going to go through and identify, well, which of these coverages are really the most important and which ones are less important, and sort of prioritize the ones that you need. And then using waivers and releases and limiting your liability in your contracts. Your contracts should do a good job of limiting liability for you, or when you send people out into the field, that your liability is protected as well. If you have partners in your business, whether you're an LLC or an S corporation or a C corporation, at a minimum you should have a buy-sell agreement, a member control agreement, a shareholder control agreement. This is essentially, if you want to think about it like this, is like a prenuptial agreement before getting married. You want to have a roadmap for how the parties will buy each other out or dissolve in the case that the partnership no longer functions. To have those agreements in place before the business is operating is really a lot more helpful. It's easier to negotiate that way. Also, if you wait until one of your employees die or your partners dies, it's usually too late. And you can think about this in terms of what happens if your partner dies. How do I get the stock back out? Does it go to their spouse? Or if the partner gets divorced, do you want to be partners with your spouse's ex-wife or ex-husband? These kind of agreements should be in place right away so that everybody knows that if somebody dies or somebody gets divorced or becomes disabled or can no longer work for the company, that we have a plan in place to get those people out of the company so the company can continue on beyond those events. At the Department of Economic Development for Minnesota has some great information. Secretary of State's office is really the most helpful government entity I've ever dealt with. They really want to help small business people get started, and they are fantastic, and obviously the SCORE folks are fantastic as well. If you are in a business that requires a license, and I haven't talked about licenses like engineers or dentists or attorneys or things like that, if you go to min.gov e-license, you can search to see if what you are trying to set up requires some sort of state or federal license. And if you're doing business in Minnesota or Minneapolis or in St. Paul, I gave you those links as well, because different municipalities may require a license as well, and you'd be surprised to find out how many businesses out there do require a municipal license. So I gave you those links. If you have questions about this, if you need any help, we'd obviously be happy to help you. Attorneys are usually very helpful in sitting down and talking to folks about what their goals are and what they need to do. I think you really need, if you're going into business for yourself, I don't know that you need to sit down and talk to an attorney unless you're kind of uncomfortable with the process. If you're going to have a partner, I think it's incumbent upon both of you to sit down with a lawyer and talk about those things. But if you have any questions, I would be happy to answer them by email or by phone, or sit down and talk with you.
Well, thank you, Peter. That's a very clear explanation of a topic that every new entrepreneur will encounter. Peter has made himself available, as he said on the prior slide. In addition, we want to encourage you to seek counseling at your local SCORE Minnesota chapter. Each of them offer many services that you will find on their individual websites. They know the local business community and can offer that insight and other experience to you. If you are from outside Minnesota, we urge you to establish a relationship with your local chapter in other parts of the country. Enter your zip code on the SCORE.org website, and you will see that there is a chapter someplace near you. There are over 400 chapters in the country. Finally, if you have other questions, we have a dedicated email address that you can pose your question, and we'll then get back to you. Just like Peter did, he had disclaimers. We also have disclaimers. As a non-profit organization, we are dedicated to helping you start or grow a business, so we must make these disclosures. We rely on various experts to present a topic, and the content is strictly for your education. In this case, that expert was Peter Brehm. SCORE Minnesota, nor any of its chapters endorse any specific vendor. And finally, any screenshots of websites and so forth are provided only for illustration and not a specific statement of fact. In closing, we want to recognize the organization that make these webinars possible. First, we are grateful to Peter Brehm for sharing his time and experience. Second, Veritas Marketing for guiding us through the technical and policy issues of producing our webinars. And third, SPEDCO, whose funding and support make these webinars possible. We hope we have answered some of your concerns about the legal structures of a business. With that, goodbye and good luck.